Hello, everyone. My name is Lowell Hanson with Schaefer Financial Management, and I'm coming to you today with Jeff Schaefer, the president of Schaefer Financial Management. It is Thursday, June 16th, 2022. Today, the Dow Jones Industrial Average was down 741 points, the NASDAQ down over 4%, and the S&P 500 down over 3%. This on the heels of the Federal Reserve raising interest rates by 75 basis points, the first time we've seen that kind of increase since 1994. All this volatility, Jeff, let's get started.
You know, it has been a brutal day in a brutal week, and frankly, what's been a brutal year for the markets. When the market hit a new high on the first trading day of the year, January 3rd, I think there was some optimism, but it feels like it's been a fairly inexorable slide since then. And on Monday, the S&P 500, the benchmark we all look at, finally fell below a 20% decline, signaling an official bear market. When you look at the broader NASDAQ, the index that contains most of the large cap, high growth tech stocks, it's down almost a third from its high, and small cap stocks are down as measured by the Russell 2000 Growth Index by more than 40%. As difficult as those numbers are, the truth is that the average stock has suffered even more. In the S&P, the average stock's down 29%, and in that NASDAQ index, the average stock is now down more than 50%. So it has been a really, really difficult year. I think the untold story of this market for most investors, though, has been the fact that there really hasn't been any place to hide from the turmoil. When we build balanced portfolios and help clients to seek diversification, we look to fixed income holdings to provide stability and liquidity and income. But the fact of the matter is, this year, with inflation on the rise and the markets anticipating the Federal Reserve beginning to raise interest rates, we have started out with the worst year through these first 5.5 months of the year ever for the bond market. It hasn't mattered whether you were invested domestically or internationally. It hasn't mattered if you were in high quality government bonds or more speculative corporate bonds. It has been a really difficult year for fixed income. And so when you put those two elements together, a really challenging stock market and a bond market that's offered no refuge, it has been a painful year for all total return investors.
Yeah, that's great to know, Jeff. And a lot of the clients are calling, asking, what next? Where do we go from here? Some are asking, is it time to sell? Others are asking, is it time to buy? What do you think?
Well, as we have thought about where we are in this market, I think we perhaps should think about this as being a two-act drama. And at this point, it feels more like a Shakespearean tragedy. I think we're nearing the end of the first act. And in that first act, what we've seen in this first 6 months of the year is that as interest rates have come up, price earnings ratios have come down. So at the start of the year, the multiple that investors were willing to pay for earnings was more than 21 times. And as you see, we sit here today with a current price earnings ratio of actually less than 15. We're below average. So if this is only a matter of correcting valuation imbalances, then this downturn may be nearing its end. But we don't know what the second act of this play looks like. And when we talk about the second act of this play, it means, what are we going to see from corporate earnings going forward? We're going to learn more about that in the next 6 to 8 weeks as companies beginning in July start to report on second quarter earnings, and more importantly, give us their thoughts about what the second half of the year holds. If the market is able to, if the economy is as strong as the Federal Reserve hopes, then the fact of the matter is that we have seen the worst of this market, and it's probably time to start nibbling. But our concern is that if we are moving toward a recession, even if we avoid a formal recession, the impact of higher inflation, supply chain disruptions, and currency pressures may put a lot of heat on this market. If earnings were to fall in 2023 to just 10% below the forecast, and you applied that price earnings ratio of 14 times, that would imply a stock market, a fair value level for the S&P of 3,100. And we're trading just a little bit below 3,700 today. Let me emphasize, this isn't a forecast. We're not smart enough to forecast what that's going to look like. I think it's an interesting exercise to go through, however, to give you a sense of what that risk might be. And so I think for those who are feeling more optimistic, see some value, see some bargains, we'd say, let's get a little bit more color on what those second quarter earnings are going to look like before we decide to get particularly aggressive and take advantage of stocks being on sale.
That's great, Jeff. Thank you. I read a book recently called The Psychology of Money by Morgan Housel, and he actually spoke at a conference we attended recently, and he had a quote that found very pertinent given the uncertainty in the markets today. The quote goes, "What is so easy to ignore in this field is that good investing is not about what you know. It's not about how smart you are. It's not about what school you went to. It's not about the connections you have. Good investing is overwhelmingly just about how you behave. It's about your relationship with greed and fear, how gullible you are, who you trust, who you seek your information from, and your ability to take a long-term mindset, long-term time horizon. That is what actually matters, and that moves the needle more than anything else." We hope you found this useful today. Thank you for listening. This is for information purposes only and not deemed investment advice. We look forward to your thoughts and questions and comments going forward.